we typically want to buy more assets than one. So really the next day we start repeating the process where we save a little bit money, start saving up money till we have enough to buy another asset, then we drain the account. Now, the problem with that system is we're breaking the compound interest curve every time. All we're going to do is add one extra step and going to get that uninterrupted compound.
Hello, and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Mettle, and today I am thrilled to welcome Anthony Faso, CPA, and Cameron Christiansen, collectively the founders of the Infinite Wealth Consultants and hosts of the Infinite Wealth Podcast. Anthony and Cameron bring years of experience in helping individuals achieve financial independence outside of the traditional Wall Street solutions. That's where I live, so I'm excited to learn from these guys, and both have a passion for educating and coaching clients and building passive income through the infinite banking and real estate investments. So today we're going to dive into their unique strategies for achieving financial freedom and discuss why traditional financial advice might not be the best fit for everyone. So in addition to these guys having a tremendous amount of wealth of information on these topics, they also have the coolest podcast room that I've ever seen. So I'm sure this is going to be epic. I'm super grateful to have you guys. How are you doing today?
Josh, we are excited to be here.
I'm excited as well, man. Thanks for having us.
This is going to be a lot of fun. So let's just go back and talk a little bit about your journey. So Anthony, you did work as a CPA, then you were a CFO, and you kind of transitioned into helping people achieve financial freedom through infinite banking and real estate. Walk me through that journey, and what was your motivation there?
I'd say the motivation, really looking back, is part passion and part selfishness. I've always had a passion for finance. I also was raised by a single mother where we didn't have much money. So money and finance was always intriguing to me. Right. Yeah. And then I watched Wall Street, back in the 80s, and I thought I was going to be more of a stockbroker, but, make a long story short, I skipped some steps, but I ended up having a CPA firm. And what had really happened was 2008. And I saw the devastation that happened, not only to me, but to my clients. And I realized I was on they were following traditional financial planners. And I realized I was on the same path as what they were on. And to be honest, it was scary. I mean, it's scary when you're in your 70s and your 401k is now a 201k and all the equity in your house is gone. I mean, so selfishly, I went looking for alternatives. And that's when I got re-engaged with Robert Kiyosaki's Rich Dad, Poor Dad. And I also encountered the book Becoming Your Own Banker, which explains the infinite banking concept. So I started just doing this for myself. I thought that this was what would be good for my family to get that financial freedom. But then my clients were like, "Hey, Anthony, I don't trust Wall Street. What should I do?" And I'm like, "Well, this is what I'm doing." And we just kind of shared that idea. And then people were looking for more information and more coaching. So I started coaching them with this. And then I had a CPA firm and, teaching infinite banking. And then somewhere way back here, I had my family. And I really, I had my priorities messed up. I needed to make a decision. And if I wanted to be the best at infinite banking, that's the only thing I could do. I couldn't be good in two different businesses. So I sold my firm. Well, it was an easy decision. The grinding out on a CPA, being viewed as an expense, right, from your clients, to kind of more giving some people hope and really changing their lives. And now I'm being viewed as a asset. So that was a turning point for me. And so I've been doing infinite banking for 15 years. And I had sold my CPA firm about 10 years ago. So now I like to say I'm a recovering CPA.
My mom says she's a recovering attorney. So I get you. It's interesting, kind of your frame there. I remember in the 2001 crash, I was doing a mortgage for an older gentleman, and he had watched his retirement nest egg go from about 700,000, unfortunately, down to about 180,000.
Oh,
And
man.
the real tragedy was he was very close to the end of his runway within like 5 years of retiring. And he decided to sell everything at the bottom and move into cash. And I remember I was very young at that age. Well, not that young, but I was in my early 20s. And so young in my career for sure. And I remember thinking to myself, like, man, how do I make sure I never do that? And then, that kind of, amongst other things, put me on the path of investing in real estate. And I remember in 2008, 2010, it got really bad for real estate. That was not a fun time for real estate. But I remember thinking at that time about that lesson I learned from that gentleman that I saw, exit down 75%. And I remember looking at my real estate portfolio, and even though the value of my real estate portfolio was down tremendously, in fact, in aggregate, I think I was negative in terms of mortgage to real estate, but I was positive in cash flow. Each month, those properties were turning over, even if it wasn't a lot, $100 positive, $300 positive, $500 positive. And I thought to myself, who cares? Like, I have passive income coming in from these properties. I'm wealthier every month holding them than getting rid of them. And over time, it'll rebuild. And who would have known 4 years later, like the market completely took off and I was positive again. But that to me is the difference between the alternative investment route and the traditional investment route. So thank you for bringing up that memory for me and kind of sharing your frame on your story.
Well, Josh, let me just add one more thing. There's another big difference here is when you're more on the traditional route, like that individual didn't have much control or influence on the outcome
Great point.
of those assets. But here with what you've done, you are in control. You can easily maybe sell assets or leverage against them, but you have some more influence on the outcome.
Great call. Great call. Yeah. Real estate's a multi-dimensional asset. You can tap it with loans. You could sell one. You could refinance in a way to improve cash flow. There's a lot of different ways you can maneuver where perhaps not so much in that gentleman's particular situation. Cameron, give us a little bit about your background, my friend. So I know that you are a business owner. You eventually kind of grew frustrated similarly with traditional investment advice. How did you get into this infinite banking and passive income strategies?
Yeah. You mentioned frustration there. Anthony mentioned, I think, intrigue was his motivator. Mine was necessity. I didn't have any money.
That's a good motivator.
Exactly. So, man, I had to figure it out quick. But going all the way back, you mentioned a story about just being in your early 20s. And that's where I came across infinite banking, late 20s. But even prior to coming across infinite banking is I knew that there was something else. I absolutely knew that there had to be something else other than, I say this with all due respect, other than what my parents were doing. Right.
Yep.
I loved them to death, but I got most of my financial information from my parents, and I looked at the situation that they were in, and I was dead set on not ending up in that situation. And so, to be honest, when I started a business here in Las Vegas, I started mid-20s, and I had some success. I was making some good money, and I started looking at ways that I could create wealth for myself. And every single person, every advisor I met with was all preaching the traditional model. And every time I sat there and I'm like, man, you know what? This is not resonating with me. This does not feel right. This seems crazy that I would put my money away for 30 something years when I'm 20 years old. And so I didn't do anything, Josh. I sat on cash for a number of years until my wife and I were buying our first house. And I'll never forget this. I was sitting across from our broker, and I asked him if he had a good book for a young couple. Just out of it by the sheer grace of God. I don't know why I asked him that question, but he gave me this weird look, and he reaches back on his desk and he hands me this book, and he goes, if I would have read this when I was your age, it would have been the difference of millions of dollars.
Wow.
I walked out of there, and I remember this too. I handed my wife the keys. Anthony's my wife in this situation. Here's my keys. And I had her drive home, right? Because I always drive. But I started reading that book on the way home, and I read that book 3 times the first night. And I was a little upset. I was angry when I read that book because it just absolutely shattered kind of the foundational understanding that I had on personal finance. And it taught some very basic lessons that most people don't know right now today. And so that's what got me going down on this journey is, man, that message resonated with me. And that's really what set me down this road. And then to summarize the rest of it, man, as I started doing infinite banking for myself, for my business, and then also personally, and man, it worked. And so I started sharing this strategy with other business owners that I knew. And then again, just kind of became a resource for them. And that's the way that I kind of got pulled into this industry. And I've been doing it for 15 years in one day. So one day longer than Anthony, but man, it's been a great run. And man, I love teaching people the infinite banking concept.
Well, we're going to get into that. But before we do, inquiring minds want to know, what was the book?
Great question. Well, the book was actually Becoming Your Own Banker.
Aha.
By R. Nelson Nash. And it's about a 90-page book. For me, my favorite page, if you guys are out there, order it on Amazon, but go read page 44 and 45 and make sure that you understand those two pages. And you'll be ahead of 98% of Americans in regards to personal finance.
Right on. Well, I'm a part of a group called Be Wealthy that is led by Brett Tanner out of Phoenix, Arizona. And the infinite banking concept is something that is talked about at virtually every quarterly meeting that we go to. Brett is a fan and definitely subscribes to the infinite banking model. I have not gone that path, and so I'm going to play in this interview the curious, naive, maybe counter argument back and forth, and we're going to play back and forth. But I'm really excited to learn from you guys. So let's just jump in. The term infinite banking is a little intimidating. So let's just start at square one, at the foundation. What is infinite banking, and how does someone apply infinite banking to their investment thesis?
I would say infinite banking starts with it's a different way of thinking. And what Nelson talks in the book is that it's all about how you think. And so we've been taught more of their traditional route on how to do things with our money. This is a paradigm shift. And however, what is interesting, it really isn't that complex, and it isn't even really that different. We really look back to how we had saved. I mean, the 401k is not really that old. It didn't come out until like the late 70s and the 80s, and it was never originally intended to be a retirement plan, but it's just morphed. It's morphed into that. We look at more what I'd say with infinite banking. Here's maybe an example, right? If we have clients or listeners that want to buy an asset, whether maybe it's their first home or maybe it's an investment home, we're typically doing is it's going to take some capital, right? And what we typically do is we're going to store it somewhere that it's safe and liquid, and we're going to save up systematically. And then when we have enough, we buy the asset and we drain our account. But what's interesting, we typically want to buy more assets than one. So really the next day we start repeating the process where we save a little bit money, start saving up money till we have enough to buy another asset, then we drain the account. Now, the problem with that system is we're breaking the compound interest curve every time. Now, Josh, at what point do you want your money to stop compounding?
In about 1,000 years.
Okay. Good answer. Never would probably be the better answer, but 1,000 is going to be pretty close. Okay. But Josh, even with you, and because particularly you're buying investment properties, that takes some cash. And every time you deploy that down payment, you're breaking the compound interest curve. All we're going to do is add one extra step and going to get that uninterrupted compounding. Josh, do you use a rewards credit card?
Yes.
Why don't you just use cash? Why do you add that extra step?
Well, because the return is better. You get that bonus 1 to 4% cash bonus or flight mile bonus.
Yeah. Basically what I'm hearing, Josh, is you're going to buy this widget, anything or anyway, you just
Right.
add one extra step, you get some bonuses, miles, cash back and such. If you can understand that, you can understand infinite banking. Because the way that I use and we recommend using our policies is this is our rewards credit card for investment purposes. So I wish I could put the down payment on my rental property on a rewards credit card. But instead, what I do is if we go back to where we store the cash, we're typically using, again, somewhere that's safe and liquid. We typically use a bank or a savings account. All infinite banking is, we're just changing where we're storing that. Okay. We want somewhere that's safe and liquid, but ideally there's some other places that are safe, liquid, are more tax efficient and provide some asset protection. And the best product to do that is a high cash value whole life insurance policy. And Josh, if you're like me, and well, I know you've heard this before, but believe me, when I hear whole life, some warning bells come off on my head. Okay.
Yes.
Right. And totally get it. And we encourage people to focus on the facts of this concept, right? We all have these opinions. And one thing we're going to do for any listeners who really want to learn about this and kind of see some numbers and how this works, we do have an online course, which we charge, I think $600 to $1,000 for your listeners. Josh, at the end, we're going to give you a link so you guys could do your own research. You don't have to go through us. You can kind of see some videos to kind of get some more information on how this works. But really all we do is, instead of storing it at a bank, we store it in one of these policies. And then when an opportunity comes, instead of draining the account, like what you're doing now, breaking the compound interest curve, we can leverage against a policy. Now, by doing so, what that allows us to do is we never touch the money in your policy. So thus your cash value continues to grow during this entire time. And the one of the ways that this does this, when we go to tap in to use that cash value, we don't withdraw it, we borrow from it. Okay, so that's why it continues to grow. But now, again, we're not using your money. We're using money from the insurance company, the investment arm of the insurance company. So there is going to be an interest to that. Right now, it's between 5% and 6%.
That's what the borrowing cost is against the policy.
Mm-hmm, mm-hmm, yeah. However, one cool thing about this is, particularly when you join this with real estate, as Josh, as you had alluded to before, there's a lot of advantages of real estate. And as an asset class, as a CPA, real estate is one of the best financial tax advantage tools. There's so many advantages to it, but we couple that with infinite banking, we can truly maximize the tax code, because that interest that we pay the insurance company is tax deductible when we use it to buy an investment property, and the money in your policy continues to grow tax-free. So even though there is some arbitrage there, but we are continually compounding. So the money from all your down payments, Josh, from all the properties that you bought since you were 24, I mean, imagine if that money was still compounding today. And that's really what the infinite banking concept is just really where we store the money and thinking about it and using it different for our investments.
I've heard infinite banking described many times. I've never heard it described the way you just did, where if I'm saving money in, let's say, a stock account or a checking or savings or treasury bills, I'm earning some return on that investment and compounding, but then I'm losing that compounding as soon as I take that money out. So that concept of the underlying asset continuing to grow regardless of my borrowing against it, and not breaking the cycle of that compounding interest. I've never heard it described that way. Excellent job, by the way. You instantly helped me think through that a little bit differently. So let's walk through that just really quickly. And I want you guys to shoot holes in Help me see the holes in my approach, if you would, please. So my approach has always been, I think of investing in terms of short, medium, and long-term investment strategies. My short-term strategies is anything that I would invest in from 0 to 12 months. My medium-term strategies are things that I would invest in from 1 year to 10 years. And my long-term strategies are assets that I intend to hold for 100 years. And hopefully my kids are smart enough to pass on to their kids. So my short-term strategies is all of my income from my mortgage business, my coaching business, my books rights, et cetera, et cetera, et cetera, in my short-term strategies. And that would probably, I would probably include like short-term holding vehicles, like investments in like treasury bills and other interest-bearing accounts. My medium strategies are usually like private money loans, real estate flips. These are things that I'm probably holding about 1 year to 2 years, and they're going to turn over and they're going to flip. Single family properties at this point for me are all medium strategies. And then long-term strategies are commercial properties that I'm going to hold for, hopefully decades. So my thought process was, why wouldn't I want to have 100% access, not a percentage of access, to my short-term strategies and medium-term strategies, so that and those are growing. And here's the thing, if I'm putting it in a private money loan or I'm putting it into a flip, I'm getting somewhere between 9 and 18% return on that segment of money. And then when the opportunity presents itself to invest into a long-term strategy, I 1031 exchange out of the house, I liquidate the private money loan, I sell out of the T-bills, and then I move that money into the long-term strategy. So if I can get 9 to 18% in my short or medium-term strategies, why would I invest money into you call it the high cash, walk me through that again, the high
cash value whole life.
Thank you. Why would I park it in the high cash value whole life that's only returning like 4%?
Great question, Josh. We get that a lot. And what I would say to you is that when you think of a life policy that's designed for IBC, I want you to think of it as the
what's
asset.
IBC?
Infinite banking concept.
Okay, got it. Thank you.
Okay. So that's a specifically designed policy, and along with the strategy, that's what I'm referring to. So the question I'm hearing you say is, why would I put money into a policy when I could earn 9 to 18% somewhere else?
Yes.
My answer to you is, don't leave it in the policy. What you want to do is you want to run that money through the policy. So the way that we communicate that to clients is view the policy as the and asset. So you're going to put money into the policy and you're going to move it into the 9 to 18% investment. And so the way that you do that is you fund the policy, and then you're going to take a loan against that cash value. And that's what Anthony was referring to when we're going to use the insurance company's money, and then we're going to make the investment. By doing that one simple step, now you've got both. You've got the cash value growing in the policy, tax-free in the background, but now you've also got the returns from the 9 to 18% investment vehicles that you've got out here. So you're going to do both is what the answer is.
But don't I have negative arbitrage between the return on the money in the policy and the cost of borrowing that money out?
Great question. Yeah, if you compare those two, I would urge you not to compare those two. You want to compare what your cost of borrowing is to go make on the investment. So if you're borrowing at 6%, you're investing at 9 to 18%. That's the comparison that you want to make. The policy is going to do what it does in the background at that 4% tax-free, but it's that arbitrage between the cost of money versus the investment that you're going to make. And now what you're going to do is you're going to look at the interest rates and the rate of returns that come from that. I would also add, sometimes, right, you can find a positive arbitrage between the performance of the policy and then the cost of money. But for now, in today's intents and purposes for your listeners, I would push that to secondary.
And probably one other piece that I'm not taking into consideration there is, if I'm making a monthly contribution to that policy, it's paying down that loan. right? So I fund it. Let's just use easy numbers. I fund it with $100,000. I borrow 60 for an investment, and I've got, let's just use easy numbers, 2,000 a month going into that policy.
Yeah. Yep.
Well, I'm really not paying 5% in borrowing cost on the 60,000 I borrow. I'm paying 5% on 58,000, 56,000. So it's almost like a home equity line and putting money automatically into a home equity line and then borrowing that money back out.
Very, very close, like similar, like a HELOC to kind of a policy loan where you have that home, and that appreciation's yours. The only cost is going to be the interest. And Josh, another plug to our course.
Yeah,
we did the math. Like there, and again, I'm a analytical person. He's a good looking one, and I'm the one with the spreadsheets. Okay, but we actually compare buying an asset, storing the money in maybe a savings account with no repayment. To the most part, kind of what you're doing, or what most people are doing. And then what if we stored the same amount of cash, but instead of a deposit in a bank, we deposit in one of these high cash value whole life policies. So same money going in, same money going out. And so this is when we really compare, really at the bottom line, like who has more cash at the end of the day. And maybe you can kind of see, if it's in our course, you kind of might expect where the answer is going to be. But we want, again, we say this a lot, there's a lot of opinions about infinite banking and whole life. Some of them are true and some of them aren't. What we want to do is focus on the facts, and really the way we design these policies and the way we use them are very different. Very different. Most traditional whole life policies don't provide cash value till year 3 or 4. They're more focused on the death benefit. Our policies are the exact opposite. We're designed on high cash value, low death benefit. So we have cash value immediately, and we have clients turning around literally 20 days later, taking a policy loan and deploying the money. We want people to achieve their goals. And most of our clients' goals is to create their passive income more than monthly expenses. So we're not going to do that by storing money in whole life or T-bills. We have to go buy cash flowing assets. And really what infinite banking does is we need to finance those assets some way, right? Either we pay cash and we lose interest, or we borrow money and pay interest. So we either give up or pay up. But with infinite banking is this unique thing right down in the middle where we can get the advantages of both. So I can't reiterate enough of what Cameron said, that this is an and asset. We want you to deploy the money in that as much as when those opportunities come, but there's going to be times when we don't have an opportunity. We got to store the money somewhere. So we're just really changing where we are storing the cash. And that just gives us a lot of advantages. That compound interest, again, each state has some level of asset protection. We haven't even talked about the death benefit. So maybe we need less term, or there's some advantages there as well.
Let's go. What was going through my mind is the tax efficacy of these products. So let's go there. And I think that's going to take us to death benefit. So one of the things I was thinking about as you're describing this is, let's just using round numbers here. My borrowing costs are 5%. My policy's growing at 4%. Am I close?
Yeah.
Or are the borrowing costs more than that? Is it 6? Where ballpark, where is it right now?
Let's say 6.
Okay. Borrowing at 6, the policy's growing at 4. But what I heard you say, I think, Cameron, is the 6% in interest that I'm paying to borrow against that policy is a tax deduction. Is that accurate? Just like my primary mortgage loan up to those interest limits?
I'll throw that to the CPA. Yes. Yeah.
If the tax deductibility is determined on how you use the money.
Oh, interesting.
Right. If you use the money to create taxable income, we can deduct it from the taxable income. But if we use it, say something personal, that we use it to finance a car that's not business related, or maybe like my kids have used their policy to finance their education. So that interest on that is not tax deductible.
Okay, so for my purposes, I would be borrowing against that policy for one of two things in the highest probability. One, I'm buying an investment property. Two, I'm financing a private money loan. Both of those are going to spin off income. So the interest expense is netted against the interest income or the passive income from that property. Is that right?
Correct.
Perfect. So then my cost of that capital isn't really 6% in that instance. It's 3.5% or something to that effect. Okay. So that helps me. That's extremely tax efficient. Then let's go to the death benefit. So now this asset is growing at 4%, and then I pass away. What are the ramifications? Walk me through what happens. Is that asset step up in value when I die? And then I think I know the answer, but is it taxed when it passes on to my heirs?
I'd say it doesn't step up, it jumps up.
Okay.
Okay. Right. Because
that's better.
Yeah. Yeah. Because what's going to happen? Let's kind of use a scenario. Again, we're designing these policies for a lower death benefit, but let's just say we start with one that's, say, $1 million of death benefit. Okay. The way the whole life is designed and the way we design it, that death benefit is going to increase. So, and again, I'm just throwing these numbers. I don't know how factual they are, right? But just for an estimate. But let's say 20 years from now, that death benefit is, say, 3 million.
Okay.
Okay. Now, let's say you deployed $1 million and bought a bunch of assets.
Yep.
Okay. So then you pass away. Then that death benefit of 3 million, 1 million is going to pay off all the loans.
Yep.
Okay. So you have the assets and your family does not need to repay the loan. And then they're going to get a income tax-free check for $2 million. So maybe the cash value on that might be like 1.5 million, but you are going to get the increased death benefit after loans are paid off, income tax-free to your family.
So there's no capital gains on that additional $2 million, but if that makes my estate greater than the death tax, then is it calculated into the death tax, and would you have to pay inheritance tax?
Well, it can be, but it doesn't need to be, right? Okay. So if you're but you brought a good point, Josh. That death benefit is income tax free, but it's not estate tax free.
Okay, got it.
Most of our clients, I mean, to be honest, are below that estate tax max. We're trying to help them to get over it, but also we're going to see what happens. That estate tax exemption is set to go down in 2025 or 2026. So we will see what happens with that. But if we are close to it, there's ways that we can put that life insurance policy into a separate trust. And then that way it is out of your estate. And then it's not included in the estate tax.
It sidesteps the estate. Got it. That was super helpful. You guys actually have done more in 30 minutes of explaining this to me than all of the other podcasts and live seminars and events. So phenomenal job. I just got to give you guys kudos. You've actually helped me think through this. Like I kept listening to this thinking there's a dimension of this that I'm missing and I don't know where it is. And just specifically what you said, Anthony, was when do you want that asset to quit compounding? And that was the thing for me that I was missing. So continue using that. That was super powerful. What else should we know, guys? Maybe you give us a couple examples of people that that are using this very well, or what other components do you think our audience should understand?
Great question. I'll jump in there. Is that what first comes to my mind is I'm going to build off what Anthony said a minute ago. If you're going to go down infinite banking, you start doing some research out there, you're going to find some people that are just overzealous about infinite banking. We're here to tell you it's not for everybody. Right. And so if you do go down this road and you start looking at infinite banking, one, make sure you do some due diligence on your own, make sure that it's a good fit for you. But putting money into a policy is not going to get you to where you want to go financially. It's that leveraging or that arbitrage, that ability to take a loan against it, and it's the assets outside of it. And so, two things. One is maintain that as your focus, but also number two is if you find a practitioner, we'd love to be that person for you if you guys are out there listening, but find somebody that can help you leverage, vet opportunities, and make sure it's a good fit for you, because that's just as important as making sure you've got the right system in place, is finding those opportunities to create cash flow.
Great. That's a great call out. Let me also ask you, that brought up for me, Cameron. We talked about the tax efficiency of it. Let's talk about the asset protection standpoint.
Mm-hmm.
So how is the investment in that high cash life insurance policy more secure than me investing in T-bills or me holding a bunch of private money notes, for example?
Yeah. If you look at the cash value, the protection of cash value life insurance, it's actually dictated per state. So it's state regulated. So each state has a different threshold as to how much or what percentage is going to be protected. I think every state in the United States has a certain level of creditor protection. I would say maybe 25 of the states have 100% protection on cash value. So that way, once you pay a premium, you create that cash value. There's no lien or judgment that can be put in place against that, levied against it. And so depending on what state the individual resides in, that's going to dictate what that level of protection is. If you guys have any questions on what state you are, feel free to shoot us an email, right? We'll give you some resources as to figure out what state, what that level is for your state.
It's great. Fantastic. Guys, this has been extraordinarily insightful for me. You've helped me a ton. Let's kind of transition here to any kind of closing thoughts as it relates to any biases or any sacred cows that you may want to, kind of dispel with a closing thought as it relates to traditional finance. And then let's make sure that we give people opportunities to bite this off in small pieces. So we want to make sure people know how to get your podcast. Let's talk a little bit more where people can get your course. And then if they want to have a consult with you, let's make sure we finish with that as well. But in terms of closing thoughts or anything else that you think that people get really wrong with traditional investment advice, let me turn that over to you and have you share some wisdom there to close us out.
Well, that's a great question. We could do a whole podcast on that, Josh, but really,
I've got a list going.
What I tell people is, what are your goals? And that's one of the things, like when somebody wants to work with us, the first step we do is get on what we call a discovery call, 15 to 30-minute call with Cameron or I. And really, we're going over your goals and to see if we're a good fit. Because really, a lot of people we found have certain goals, but they're putting their dollars in a different area. Like they are not connected. Hey, I want passive income. I want to get into real estate, but I'm putting all my money in the stock market or my IRA or 401k. You cannot turn that into passive income. So the biggest thing is, like, if you love your job and don't want to lift a finger or worry about finances, typical financial planner is good for you. You're just going to sign over your money and then come back when you retire and hope it's there. But if you don't want to base your financial future on hope, you need to take control of it, right? And so if your goal is passive income, can't get that from a traditional financial planner. You're going to have to make some steps yourself. And we'd encourage you, start with Rich Dad, Poor Dad, and then upgrade to Cash Flow Quadrant, because I think that one is the best book. And then if you are so inclined to incorporate infinite banking, that is going to help you achieve your goals faster and with more certainty.
Boy, I think you just laid out a really great foundation there. If you are if this is all kind of new to you and you find it interesting and you have maybe a distrust for the traditional financial model, start with those 3 books. Those are the first 2 that he mentioned around Kiyosaki are absolutely the foundation point for me in my journey. And then will you give the Infinite Banking book one more time as well, Cameron?
You know, let me just add one more thing on that, Josh.
Becoming your own banker. Great. Thank you.
Yeah. Becoming Your Own Banker by R. Nelson Nash. You can get it on Amazon, but we need to add one more step, Josh. You need to not only read those books, but that's just giving you knowledge. You need to put it into action.
Great.
Right. Because how many times have we, I mean, what I found interesting, I don't remember the number off the top of my head, but Rich Dad Poor Dad has sold multi-millions. It might even be over the 10 or 100 million books. Nowhere, but how many people are actually implementing it? Right. If you're listening on this podcast, you have some inclination or that you want to make a change. To make that change, you're going to have to take some action. So you can read these books. I mean, maybe I'm a little biased because we helped design this course, but there's some great content in there that you can go and find out for yourself if this is for you or not. You don't have to have us call you or be on a call. Like, you have the ability to do your own due diligence. We're giving you those resources. And if you want to work with us, you can easily get on a free call and we can see if this is good for you.
Great. Love it. Thank you for that additional step.
Josh,
Cameron.
I got 2 things. You mentioned at the end kind of some parting advice, and I think you also said for somebody that's looking to get started. So I thought of beginners. 2 things that I wanted to share there is echo what Anthony touched on during the podcast. I think it was really, really important. If you guys go down this road and you start researching infinite banking, you need to get really good at separating fact from opinion. Right. And so as you go down that, you think about whole life insurance, everybody's got an opinion. I would tell you, do your own work, read the contract, and make sure you understand that. There's no gotchas that come along with whole life insurance. Everything's laid out there for you. And I'll say that's one of the best blessings that I've had in my life is that been able to tune out the noise and just strictly focus on the fact, hey, is this a good fit for me? And so that would be a parting words of wisdom. The other one, man, if somebody's just getting started or kind of starting to look at the investment world, as I always tell people, is word or language is important. In our industry, there's 3 words that get mixed up and used interchangeably. It's saving, it's investing, and speculating. They mean 3 drastically different things, but they often get used interchangeably. Guys, if you go out there, understand that saving, in our opinion, is an action verb, right? It's, hey, I'm intentional. I'm saving 20% of my income. I'm moving it from A to B. Investing, there's a level of due diligence that needs to happen before you deploy any money into whatever you want to do. And so it's education and make sure you're vetting the opportunity that's there in front of you. The third one is pure speculation. Speculation is what 95% of people are doing out there, and they're just throwing money, right? Somebody said it's a good idea. They feel like, hey, it's a shiny coin. I want to throw some cash at it. Stay away from that at all costs. If you can stick to just savings, being disciplined there, and investing in what you know, you're going to be in good shape at the end of this.
It's great advice. And I never forget hearing Robert Kiyosaki write or say that an asset is something that spins off positive cash flow. And if it doesn't spin off positive cash flow, it's not an asset. And I was just like, that was so revelatory to me and so helpful for me in terms of like setting my trajectory. Guys, this has been a ton of fun. We're both experts at explaining this, and the way you duo back and forth is super powerful. I'd love to have you guys back on a future show. But for now, please close us out with how can people get your course, and how can they just learn more from you and set time with you if they'd like?
Yeah, guys, there's a couple places you go. One is you can go to our course or our website, infinitewealthconsultants.com. We've got all the links to social media and everything right there. As a thank you, Josh, for having us on, is we did create a landing page for your listeners. Again, Anthony mentioned the course. We typically charge, $500 to $1,000 for access. As we start to add value in there, that price has gone up over time. But we're going to give you guys free access. And so if your listeners want to go to infinitewealthconsultants.com/infinite financial freedom. That'll take them to the landing page. Josh, if it's okay, I'll give that link to you and you can put it in the notes. But that'll take them right there. And then, like Anthony said, go in there, check around, take a look at the course and see if it's a good fit for you.
Now, we have a section called IBC 101. There's 3 videos, and I think the runtime's 53 minutes. If you're a real estate investor or you're looking to do something different than traditional finances, take the 53 minutes and learn to see if this is a good fit for you. And if you have questions, there'll be many links in there to get on the call with us.
Fantastic, guys. I can't thank you enough for sharing so generously with our team. We'll put those links. Also, if you guys want to leave us your email addresses or what have you, we'll make sure we put those links in the show notes. But thanks for being with us today. You're a fantastic guest, and we look forward to having you back in the future.
We'd be honored. Thanks, Josh. Go make it a fantastic day.
Take care.
Thanks, guys.